Hey folks, welcome back to the Real Estate Excellence Podcast. Today we have a little different show as I want to cover an area that is so vital to the real estate lending industry. My 16 and a half years of being in the mortgage lending, you find not everyone is a round peg that fits in a round hole. Occasionally we have some really square pegs, but they don't fit in the round hole. My guest today works for a company that helps round the edges or simply creates the square hole for the square buyers, if you could put it that way, my analogy. I apologize if that offends anyone, but I thought that was unique. He works for a company that specializes in portfolio lending, and we're going to explain that to many people because I know many agents and many consumers don't understand what portfolio means. Lending. Let's welcome Chris Russell with iTHINK Financial to the show.
Well, thank you. Good morning to everyone. And let me start with this. Portfolio lending simply means that typically the lender is lending money that they have on hand, if you will. They're lending money that they have, and they are not lending that money or doing that loan in order to be able to sell it, which is typical, let's say, of a VA, FHA, Fannie Mae
into the secondary markets of the...
Exactly. So a portfolio lender typically makes their money by keeping the loan, servicing it themselves, and ideally holding on to it permanently. And so because of that, portfolio lenders have the ability to say, listen, I don't want to follow the rules, let's say, of Fannie Mae. And that's kind of how we've built this program, is by writing our own rules and living by those instead of rules that the federal government may have issued that we may or may not fully agree with relative to underwriting.
Well, I mean, as a loan officer, we experience it all the time. I've had several in the last month where they're, really great people. They have a great business wherever they're at, been doing it for 20 years. They've got cash in the bank and so forth. And they want, where Fannie Mae and Freddie Mac have all these guidelines. And my new thing now today, I tell the real estate agents and to my borrowers, I'm telling you right now, if we ask for another document, please don't call me and say, why are you asking for this document? They're asking it for a reason. It's because it's required. That's part of our life right now. And paperwork after paperwork and that sort of thing to meet those guidelines of the what we call conforming loans, yes. The Fannie Mae that can be sold on the secondary market and so forth. But I think is like I said, it's going to take those square pegs and either make a square hole or round the edges and get them in there is the way I use the analogy. But hopefully the real estate agents can relate to those unique buyers who are quality people, just they don't fit the guidelines at Fannie Mae and Freddie Mac. They fall outside those edges.
Well, I think you should be giving one of these talks too, because you nailed it. That's exactly right. Our programs are really built around those quality borrowers that are running into issues. Now, that said, those issues can range from the property itself. For instance, an easy one is if you want to buy an A-frame house. Who's going to finance an A-frame house? And it's a challenge, and it's a challenge in the marketplace, and it's a challenge with the lenders. Our programs, because we focus so much more on the quality of the borrower, we're going to worry a lot more about the borrower and their qualifications than we're going to worry about whether it's an A-frame or a
log cabin
or a dome home.
Oh, yeah.
We recently, as a matter of fact, for your firm, we recently closed about a $500,000 loan on a large log cabin out in Colorado.
Yeah.
It takes a little more work to understand what's going on in the property. This particular property was held in a trust, so we needed to lend through and to that trust, and we were able to put that transaction together.
Having, started at Quicken Loans and Loan Depot in a call center, not every lender does everything, is what I found out now. Jet is really the fourth lender that I've worked for, and what I found, those guys are dealing high volume with the straight and narrow loans, your FHA, VA, and your conforming loans. They're not going outside the box. When I got out and started working for a bank, they offered a portfolio product. That's where I was introduced to it. And so for the agents out there who might be listening or borrowers, you have to understand you may be talking to a loan officer, but only who they're working for. they only offer so many products, right? So that's where Chris comes in here with us here at Jet. Is he's offering, I think financials are connection for those outside the box situations, whether it's property or unique income qualifications, or a combination of both sometimes, right? You have a good equity but unique borrower. We'll talk about getting the details. But Chris, tell us a little bit about yourself. Where are you from? Where'd you grow up?
Oh, unfortunately, that's a terribly long story. I'll go through it quickly. Born in Philadelphia and then down into Kentucky. I grew up, however, as a child primarily in South Dakota. Just an absolute wonderful way to grow up. Washington State, up into Canada for a brief time, and then eventually I settled in New Jersey. I went into the service.
Oh, sorry for you.
I loved it. I was on the beach all the time, and
well, I guess there's parts of New Jersey we can.
South Jersey for any of you who are listening. But about 32 years ago now, I came down to Florida on vacation and went sail fishing. Instantly caught a 7-foot-long sailfish, and that was that.
You're done.
I was in the real estate business in New Jersey. I was a real estate broker, and went up there and sold my company, and a short time later was living in Florida.
So did you actually start in selling real estate in Florida? Did you just go from Jersey?
No, I came down to Florida and I went fishing. I had the world's best tan, and at some point I realized I had to get another job. And, so the bottom line was I got involved with a huge bank in Florida, a company by the name of Barnett Bank. They sold out a number of years ago. But I found that I really enjoyed more working in the community type setting. So the balance of my career in banking has been with small community banks, and now with the credit union, which is just a wonderful place to work, and really a good employer and a darn good lender.
Well, oftentimes we have to rely that's where the smaller banks or smaller institutions come up with these creative products. I think people often, we see movies, back in the 30s, 40s, 50s, where the farmer goes into the bank and he needs money or whatever it is, and they don't have pay stubs and W-2s. They're that bank is making a human decision on what that person, knowing that person, living in the town, knows the property they're going to lean against, and is taking that risk, because that's the position the smaller banks see themselves as more as keeping the community thriving, right?
You're 100% right. Until a few years ago, I was president of Oculina Bank down in the Vero Beach area, and the credit union bought our bank. And the only thing, the biggest difference is that it gave the entire credit union more resources. And because credit unions are typically very, very community-oriented places, and certainly ours is no exception. I would say we are uber community focused.
But would you say your community has grown with iTHINK?
It has grown. It has grown quite a bit. We're still centrally located. We're based out of Delray Beach, Florida. We have offices throughout Florida and up into Georgia as well. We have a very nice footprint in the Georgia marketplace. This particular product is one that we use pretty much nationwide, with the notable exceptions of Alaska and Hawaii.
So give us a little bit of history of iTHINK. Where did it actually evolve from?
So iTHINK is 50-some years old, going way back to the days of IBM. Surrounding IBM, small credit unions started popping up, and they were not necessarily a part of IBM, but they were there to complement what IBM was doing, and that way they could serve and service the people working for IBM, because when IBM would open a corporate office, there were a lot of people there. And so our original name was IBM SECU. So we were the IBM Southeast Credit Union.
Interesting.
And so fast forward, when they bought our bank, when they bought Oculina, they were still IBM SECU, and then very shortly after they purchased the bank, they changed the name to iTHINK. They really did, I think, an excellent job of doing that. They kept an awful lot of everything that was good about IBM Southeast Credit Union. The new branding is more designed to take us for the next 15, 20 years.
Sure. No, that's a very interesting story, but it kind of gives the background of the products that you are offering on a national basis, really, much like the small credit union or the original IBM Southeast Credit Union may have offered some of their employees. Someone moving, imagine someone got transferred in or was offered by IBM. They were quick to try to get that person into a home and leveraging the job with IBM as the...
You couldn't be more correct. In fact, and that's kind of how we started. We got more spread out with this, as you will. Over the years, people retire, people move, people do this, people do that. But they are members of our credit union. So let's say, an IBM employee decides it's time to either move or to retire, and they're out in Arizona, but they're one of our members. We take their membership very seriously and very much to heart. So they would call us and say, well, I'm out in Arizona and I need a mortgage. Well, you're our member, so we want to help. And that's what you'll find with especially with a credit union. We're not gonna say, well, you're not here anymore, so we're not going to help you.
Right.
We still want to reach out and assist those people with what they're doing.
So for my listeners out there and the real estate agents that maybe obviously, hopefully, are educating yourselves on portfolio lending as something in your tool chest, because trust me, we get clients. There might be 1 out of 100 that might fall into this. I don't want to say 1 out of 1,000 because I think it's probably more than that. Yes. But you got a lot of unique situations of people moving from all sorts of parts of the country. And as everyone knows, everybody's loan application is different. How they earn their money, what they're coming from. Maybe they are retiring and downsizing and they get different incomes, but a lot of assets. We'll talk about that. But so to utilize the products, as we talked about a little earlier, they need the agents to want to bring them to Jet Home Loans or a few other, FBC is the other lender from that standpoint.
Yes.
But you are working these portfolio products. You work with a select group of loan originating companies that are out there.
Very select. I'm so happy to say that Jet is one of our clients. FBC, of course, is one of our clients. But we only have 5 clients in the country. We one of the things about these programs, which we wrote, I guess about 15 years ago, one of the big things about these is we do not originate. We do not originate. Our business comes from our quality brokers that we're so fortunate to deal with.
Right.
And so these products are handled primarily through the people in the field, such as yourself, and then we become the approver and, if you will, the buyer of that loan. And then again, we service that as the portfolio lender.
So let's dig a little bit. I think because the facts tell, stories sell. That's always.
There you go.
I know you've got a ton of stories, so I'm gonna see if I can draw some out of you. And I know just listening to your presentation a couple of times now, you've got a bunch. So for as if we're talking to our audience out here, who may be a borrower who may fall into this, and I'll start off with my examples we just talked about upstairs in the training room. My borrower has a lot of equity, but she's getting a divorce and actually needs to refinance the house to get the husband off the deal. So her income, because she's just getting back to work and she's personally training, so it's not a W-2, wasn't a big offer letter from IBM or anything like that, but she has a lot of equity. She has reasonable assets, not anything crazy, and good credit. And that is a unique situation. So my loan is particularly in process now, but we're putting that through. But we have a scenario desk. So those agents out there, if you have a scenario, we get the information so we can present at least to the initial
Correct.
gatekeepers to see if it is actually something that you guys are interested in. Let's talk a little bit about, if we could talk, since we're on the scenario desk. unique properties at Fannie Mae and Freddie Mac. Could you give us some examples of that?
That's kind of how the whole program began roughly 15 years ago. Is I was having lunch with a good friend of mine who's a broker, and I said, with Fannie Mae, with the crackdown that we were seeing at the time, and the fact that we were going through, I don't call it a recession, I call it a depression back in 07, 8, 9, 10.
Right.
But as we were going through that, I said to him, what are you doing with these wonderful borrowers? In this case, we were talking about, for instance, oceanfront condominiums. So nice prices, and yet the prices, of course, had all come down. But I said, what are you doing with a qualified borrower who goes into one of these where Fannie or somebody, any agency says,
because there was a period where condos in Florida were flagged.
Exactly.
Yeah.
And so maybe it was flagged because there were too many foreclosures, or maybe it was flagged because there was too high a concentration of renters inside the property. And a light bulb went off. And because the broker said to me, well, what typically happens is they'll apply 2-3 places, they get turned down, the property's not acceptable for this reason, the property's not acceptable for that reason, and they end up angry. The seller's angry, the buyer's angry, the broker has wasted their time, the mortgage broker has wasted their time. And so everybody's just frankly upset. And as I say, light bulbs started going off. So we went back and my team started writing up the guidelines, the parameters for transactions that made sense. And so today, everything that we do is about whether or not it makes sense. So we certainly care about the collateral, we care greatly about the collateral, but we are not intently focused on the collateral. And to run that all the way through, if a borrower is a good, strong borrower, and they're going to occupy as their primary home an oceanfront condo or any condo that has a high percentage of renters in it, that can be a real problem with government agencies. That's not a problem for us.
Right.
We're going to go back and look at the quality and the qualifications of that borrower primarily. It doesn't mean we have no focus on the collateral, but our primary focus is going to be on the quality of that borrower. You had mentioned, a borrower with good credit. One of the things that we do very, very well is we look at the actual credit report, and we really don't look at the credit score. So we may look at it, we'll write it down, whatever, but we're going to look at the quality of that credit. And if the score is below
Describe that, because you did mention that upstairs, and obviously most people look at the score because it generally reflects of what they've been doing, at least lately. Are you looking at the different accounts and how they're spending?
I've been doing this for so long that I look at the score at very best, as a guide. It may help you, it may not help you. And as a good example of that, somebody who 2 years ago missed one payment on a $18 credit card bill and has a couple of medical collections, they can find that their credit score has just been trashed. When we see that, we want to go in and focus on the quality of the credit. What's the actual debt to the revolving limits? How are they doing with paying their other bills? How has their mortgage been paid? That type of thing. So as opposed to plugging in a score and having a computer tell me whether or not they qualify, we have fabulous underwriters who go in and take a look at it, and they will make a human decision as to whether that's a good
credit
one.
may be the deciding factor. Because I can imagine a score, how someone's got a great credit score, it's easy to say, well, I can look at accounts, or I would say they got great credit score, so I don't have to get as deep. But when you got that situation where you are making that personal decision, that you will dig into it. And the other thing you brought up upstairs, we're going to talk about compensating factors here in a minute, so I'm going to hold that. Make sure we talk about that so everyone understands, the listeners understand what the compensating factors are.
Sure.
But let's you dig into the credit report to see if there's an angle that push the client to approval. How about the self-employed borrowers? Because I think this is probably the 50% of the whole.
Self-employed borrowers are a huge, huge part of what we do. I often hear borrowers say, well, I'm self-employed and my companies are complicated and nobody really can figure out my income. And
they all are.
Yeah, well, and I have to tell you, in my opinion, that borrower has not yet been born. One of the things that our company does so very well is that we have a group of people who will actually take self-employed tax returns and spread them. And we almost do it as a commercial set of spreads. Now, anybody who's involved in the mortgage industry knows that there's a Fannie Mae form where you can take this from this tax return and take this from this tax return, and that's the income.
Right.
And what that is what it is. We actually have our own proprietary system for how we spread it and what we calculate. And we dig very, very heavily into those tax returns. It is not at all uncommon, it's actually more common than not, that the income for a self-employed borrower, especially one who may be a little bit complicated,
Right.
it is typical that our self-employed income is actually going to come out higher than if you were figuring it on a Fannie. Because again, it's our program, we are a portfolio lender, and so we've got our own, as I say, proprietary way of spreading this. And of
Right.
course, we make that available as a free service to you folks.
Right. So, in importance to everyone, the listeners out there, you're more or less sort of doing some forensics on those tax returns.
Well said.
Understanding how business works, and it's done from a human ability versus, like you said, Fannie Mae and Freddie Mac. They're trying to train underwriters to do a high level volume. So they're going to tell you, we want line this and line that, and then this line, and then this is what your income is going to be. And that's pretty much the way it is, unless there's some gray area. You are really looking in the gray.
When you do it utilizing that method, what you're doing is painting every borrower with the same brush.
Right.
We prefer to say that every borrower stands on their own. And so we're going to analyze the tax returns, we're going to analyze the credit. And at this point, I think it's important, too, to mention we don't utilize, for instance, DU. We don't believe in using computers to approve somebody for for their dream home. We don't believe in
Maybe
that.
a calculator is probably the only technology you bring
Certainly
in.
for me.
Yeah.
And so computers are a very small part of the way that we underwrite. Ours is done by humans, and all we've really done in writing these programs is gone back 30-some years to the way it used to be.
Right.
And the way it used to be was making common sense decisions on loans. And really, for the products that we offer, that is exactly still what we do today.
All right, so I mentioned compensating factors before we got into tax returns, because I think a lot of, I'm approved to teach the Intro to Real Estate Finance. It's in that class, talking about compensating factors. So the listeners out there, we go back. I mean, the list of obviously having cash is a big compensating. Having assets is a compensating
I'll interrupt
factor.
real quickly there,
Yeah.
but assets can mean everything. Assets can absolutely mean everything. They can overshadow a somewhat elevated debt-to-income ratio. We actually have an annuitization loan where only on paper we can take a borrower's assets and see if they qualify, if they were to divvy that money up in certain ways and start having, let's say, draws. Now, the difference is we never make them take draws,
Right.
and we have no age limits on any of that. So if they're a young person, they've got a trust account or the brokerage account, that type of thing, it allows us the latitude under our programs to say, this loan makes sense, and if this borrower were to start drawing money out, this is how much legitimately they could draw out.
Now, just so we could cover that assets, because some people have a couple $1,000s in a 401k, for example, versus that other client that has a couple $1 million in different vehicles that they've got out there. They don't really want to draw off that money and pay cash for a home, especially with low interest rates. So, but they're using that as when you really need to use, I'm not talking to like push someone over a couple percentages points on a debt ratio, but from a compensating factor, what amount are you looking for? The 1 million and more type substantial assets, or really someone with that we need a few $100s a month from you to look at that 401k? I mean,
it's typically a little more than a few hundred a month, but it is definitely less than $1 million. And we see multiples of millions of dollars in assets where we'll approve a loan for somebody who may not even be working, but they've got really, really tremendous assets.
Right.
But going back to your question, So somebody who, let's say, after closing, and maybe we've calculated the debt to income, and they're a point too high or 2 points too high, but after closing they have $800,000 or $900,000 in the bank, we may want to go in and just on paper. Again, the borrower never knows we did it.
Right.
Nobody gets involved in it. Because it's a common sense decision on our part. So we may want to go in and actually credit that particular buyer with some additional income that they could have if they chose to avail themselves of starting to draw down a portion of those assets. And I know I keep saying it, but you can't say it too much. It really comes down to common sense.
Right. Right.
And
because it's, well, like if we're trying to do this for those other, if we're trying to do, because Fannie Mae and Freddie Mac have their asset depletion programs as well, but you actually, there's a calculation, and that's the calculation you have to stick in there. And if that's not enough money to get them below the debt ratio, you fail. And in your situation, it's a human decision. You're looking at, oh, they got $700,000-$800,000, whatever. That human is making that decision. Again, if it comes back approved from iTHINK, you don't ask questions. Right. It's approved. Let's move on to the next step.
Well, one of the things I was saying, we recalculate debt to income on all borrowers. And one of the things I was saying earlier was it's not unusual for somebody such as yourself to submit a loan request to us that you may have calculated it at 45% debt to income, which is basically our threshold, and you may get an approval back saying no, it's at 38. And we always say, don't question that.
Yeah,
that's what our humans are doing internally. They may have gone in and said, this one's a little bit tight, but when you look at the assets, it can make tremendous sense. And so that's why full 1003s, and that's the hard part. For any loan originator, it's so difficult sometimes to say, okay, take off your Fannie hat. Because Fannie doesn't, frankly, in my opinion only, Fannie does not always equal common sense.
Right.
And since we're a common sense lender, we're actually looking at the transaction, and at the end of the day, we're saying, does this make good common sense for a loan that should be in our portfolio? Okay.
So assets are obviously a compensating factor. You're evaluating the credit, and things are squared away there. The property, equity in the property.
Equity always matters, of course, on anything that's a primary residence, whether it's a condo or single family home or a duplex, but it's going to be their primary home. We're at a very strict loan to value limit of 80%. But let's stay with that a second. So we may take somebody who's in a single family home at $700,000. They want to put 20% down, and there may be this factor that's working against them, or that factor, and there can be a multitude of things, as we all know.
Right.
As we all know. So it's not unusual for us to say, well, look, we actually like this, but we have found a weakness in it that is a bit of cause for concern, and we may come back to you and say, okay, we're actually going to approve what you sent us, even though it doesn't fit correctly. We're not having a good time getting that peg in there, if you will. We may come back to you and say, look, we know that there's plenty of cash there. This would be a much stronger transaction at, say, 75 or even 70 than at 80.
Right.
But the way that we underwrite it, because we do require a listing of 100% of the assets on the 1003, and again, that's a big departure, as we all know, from
taking
Fannie.
the full,
And it is that 1003 that allows us to go in and say, well, normally we couldn't do this. But in this case, for instance, the assets are so strong that we look at it and we say, okay, have them put another 5 or 10% down, and let's go ahead and get to closing.
Right.
And one of the examples I used this morning, and please don't flood me with these type of loans, but one of the ones I used this morning, we have quite a number of fly-in communities that we get involved with financing the home and the hangar and things like that. We had one not too long ago where the gentleman was just so qualified, it was unbelievable. But the living quarters in this case were almost pushed up into really his airplane hangar. And a single gentleman, and I looked at the loan and I became convinced that it was going to be his primary home. He had already been, I think, to 4 other lenders, and I looked at it and I actually talked to him, and I said, I just need to know. And, I'm sorry, but sometimes you can just tell when people are being honest.
Right.
This gentleman was being honest with me. He was tremendously well qualified,
Right.
and we approved the loan, and boom, we were off and running.
Right. I was listening to your story there, although I heard that story upstairs.
I have too many. I have way too
All
many.
right, so the skeptical one that's listening to the show, okay, what is the difference between what you're doing? I understand, but for our listeners, from what you're doing versus some of the crazy lending that was being done prior to 2007-8.
I wish that lending hadn't been done. A lot of us old timers were worried about it then. We do not do, for instance, Ninas. We want to know what their income is. We want to know what their assets are. And obviously, as we've covered now, assets are critical in making a decision on a particular transaction. While we don't credit score, we want to see generally very good credit. So we're just not interested
see
in
the
the
other
score.
debts and how they're
Exactly.
You know.
We don't cut corners on a full package. We need a full package so that we can develop a picture of that particular borrower. And I'm going to hesitate here and say that through you guys, you've got an approval rate with us of probably in excess of 95%. I think that speaks to the fact that you guys have a tendency to dot your I's and cross your T's.
Right.
And thank you very much, but you're submitting high quality loans to us. So we go in, and again, we're going to make a common sense decision, but the differences between us and Fannie Mae, again, I think the biggest one is we're not using a computer that takes
Spits a
in
report
data
out.
and spits something out that says don't do it. I can't. I still have a
Right.
hard time grasping that.
Right.
So we're using human beings that will take a look at it, that will understand the story. We're not the bad credit lender, but if somebody has had a scattered 30-day or God forbid 2 in the last 12 months, I always use the scenario where the mom and dad have a kid at college and they've co-signed for the car. The kid made a payment 30 days late in the last 2 months.
Yeah.
And
Mom and dad don't have credit monitoring.
exactly. And we want to know what caused that too.
Yeah.
We want to document it. We want to understand it. That is not a bullet in that loan. That
Right.
means that we need to maybe dig a little harder. We need to understand it because, again, we are looking for good credit.
So actually, more. It's really, when I think about it, I was listening to you say that. When Fannie Mae and Freddie Mac, you only want to tell them what they're asking for. You don't need to tell them any more, like assets. If they don't need any assets, leftover reserves, as we call them, after closing, because they're putting 20% down and have great credit, they only need to show they have enough money to bring to the table to close the loan. That's it. That's all they want to know. In your situation, we want to give you every possible thing because you're going to utilize or leverage every possible nickel that you
Without a
can
doubt.
to hopefully get them to approval. So you really know more about the borrower than a typical Fannie or Freddie loan.
Without a doubt. One of the stories I was telling you upstairs is not very long ago, we approved and closed a super jumbo for $20 million. And the $20 million was for a new primary home. Gentleman's moving down from a state up north and bringing all his employees with him, bringing his entire company with him to
Oh, my
Florida.
goodness.
God bless him.
Yeah.
And that particular gentleman owned well over 25 companies, all of them terribly active, all of them doing business. And he'd been elsewhere, and people were saying, well, we can't help. And
Most of them don't want to help because
Well-
that would take a month to get all.
and actually, once we got hold of his accountant and got what we needed so we could analyze the tax returns, we had it approved in a couple of days.
Yeah.
Literally in a couple of days. Now, certainly loans don't get done in a couple of days in the market we're in today and in the world that we're in. Our process that we add to it, generally, you're looking at probably 2 to 4 business days. So we're not hampering the approval process and we're not hampering the closing process.
Right. Give us a story of some examples that you've had. I wrote down in my notes. I said that was a victory there. I think that one there with 28 companies, the average loan officer like me, I'm like, oh my God, I don't have enough assistance. And then to track all this paperwork coming in from the accountant, and really you guys probably got through half those companies and kind of browsed the other half and said, yeah, these are all good.
Well, believe it or not, no, we went through all of them because they were all such active companies. So we needed to go in and pull the true picture of the income out, because why are 4 other lenders saying, well, there's an issue or there's this or there's that. We didn't find that. We found that this particular borrower was unbelievably well qualified to buy this particular property, in this case for $30-some million.
Right.
And so we take a look at 100% of it because, again, as a portfolio lender, we want the files to be as clean as possible and make sense when they're residing in our portfolio.
All right. I know the question I wanted to ask. So I can imagine one of the listeners here is like, well, why don't we just send all of our loans to iTHINK? The products that you offer, if you can expand on them, you're not offering a 30-year fixed mortgage.
We do not do 30-year fixed, but that's because we are a portfolio lender.
Because your portfolio,
Obviously,
your
we have
investors
interest rate
want to
risk.
see. I guess what is the investors in these types of things want to see a turn of their money and on an average period of time.
Well, a responsible lender, and we are without a doubt a responsible lender. A responsible lender wants to know that at some point the funds will reprice, and they have to do that because otherwise interest rate risk becomes this bear that's sitting over you at a time, as we need to acknowledge that interest rates are going up, and I think we would agree that they're going to continue to go up. So primarily, now the good news is we don't offer a 1-year ARM, we don't offer a 2-year ARM or a 3-year ARM. Our ARMs start with a 5-year fixed period. We do have 10-1 ARMs as well, and those are basically, with the exception of our bridge loan, but those are basically our two product types, the 5-1 and the 10-1. Lately, we're seeing an awful lot of buyers that are gravitating actually to the 5-1 because they're playing the curve. They believe, there's a lot of borrowers that believe that in the next 5 years, if they take a 5-year fixed period now, they'll probably be looking at a dip in interest rates over that curve. So that's why there's
short
a good
and long
spread.
term money, especially on the larger loans.
Yes.
The more savvy person that is able, that is financially able to buy, and when you start talking millions of dollars or more, used to working with the adjustable rate mortgage, because normally there is a spread.
Yes.
When obviously, well, I say normally, I've been in it 16 and a half years, and the last decade there hasn't been.
Yes.
Yeah, everyone went to the 30-year fixes. Why not do that? It's only 0.25% more in interest rate or whatever. Why would you do the adjustable rate when I can borrow, at 3% for 30 years? We just grab that, right? But they know that loan is going to turn over. So I asked you the question a minute ago. One of the problems about the pre-2008 loans were at that adjustment period, and that's what. Oh my God! But the reality, the buyer or borrower here in this case, that's going to use an iTHINK product, 5 or 10-year ARM that's based on a 30-year amortization.
That's exactly correct.
Yeah, it's going to give them that payment. It's not a balloon; it's due in 5 years. But the hopefully that whatever their situation may be, obviously the property is unique. You can't change that. But if it's a borrower uniqueness that doesn't fit in the conforming loan products, that we get in there, that hopefully within 5 or within 10 years, they're going to eventually get back on the track of things and be able to jump to a conforming loan is the initial thought.
Well, yes and no. So for instance, what we typically see is a self-employed borrower where people are having trouble understanding their income. That's usually going to continue forever.
Yes.
And so they're not going to be that typical Fannie Mae borrower. Okay. And then you get into the super jumbos, and to be blunt with you, we bring in a tremendous amount of jumbos and super jumbos from people who would otherwise qualify in
under Citi or Chase's guidelines.
in a ton.
Because there's only a handful of lenders doing jumbos.
Exactly,
Yeah.
but the brokers, the few brokers that we're fortunate enough to deal with, understand that our process is often easier, and again, because we're using common sense, they will tell their borrowers, "Look, I've got a shop where I can take this that will get this done with a great documentation. Don't get me wrong, but a minimum of fuss and a minimum of application of the rules." We don't like to get back to people and say, well, now we need this, and now we need this, and now we need this. We prefer just to try to get that complete package up front, run it through, and go with it. One of the other things that can make somebody non-Fannie, if you will, for the entire life of the loan can be the property itself. If you have going back to an A-frame or
large acreage or the small little
large
home.
acreage. I always tell the story. We have a very small home sitting on 280 acres up here, not far from here actually. that we've had on our books for quite some time now. So why would we do a loan in a small house on 280 acres? Well, because it made sense. And so that's what we will always come back to. Does this make sense?
Right.
And if it does, we're happy to get the loan done.
My question was number 10 here. I have, can you explain how iTHINK evaluates risk? I think we've tipped on it a little bit, but can you kind of conclude how because that's what I think a lot of people don't understand from the lending. Like I mentioned at the beginning of the show, hey, you're self-employed. You want to, you want this conforming loan because you want a 30-year fixed. Okay, when they ask you for more paperwork, just give it to them, because they're not asking for their own personal health. It's because that's what the guidelines say to do.
Well, and ours is
that.
not so much a guideline. We're asking, if we ask for additional paperwork, it's because we're looking for a way to make the transaction work.
Right.
It's just that simple with us.
Right. Well, I mean, I think it's the same way even with the conforming loan. But the underwriter has these guidelines set by Citibank or Bank of America or Wells Fargo, the big lenders that are lending like the jumbo loans.
Yeah.
They have like. Here, this is because that's what they have in there. Now, your situation may not be the situation they were thinking of, but it falls within the circle. So they're going to grab all this other documentation and continue to ask for you from you, because that's how they evaluate risk in their little glass room that you're in. You guys are evaluating risk obviously on a personal basis, but obviously having at least 20% down is a big one.
Well,
right?
and a lender who's not selling on the secondary market, such as us, a portfolio lender, when we evaluate risk, the way that we get our money is we don't call them customers. The people who belong to our credit union are members. When you open an account with a credit union, you become a member of that credit union, and there's tons of benefits that would occupy a whole other show just to talk about why somebody should belong to a credit union, assuming they can. So when a credit union is lending money, they're not lending their money. They're lending the money that their members have deposited with them.
Right.
So when you evaluate risk, the first thing you say is, am I wisely lending out my members' money?
Yeah.
And
that's very well. I like that.
I remember over the years in training other underwriters, you would say to them, so you like this? And they say, yeah, well, would you lend your mom and dad's money to this person to buy a home? And believe it or not, that can be a wonderful way to approach whether or not a loan makes sense. How comfortable are you? Does this make sense?
Yeah.
And then diverging away from that, as I say, we have a number of brokers that we deal with, loan officers, I should say, that we deal with, that send us loans because they've learned our products over the years. We all know that sometimes lenders will paper you with this request and paper you with this request and pay. We don't believe that we should be doing that. We try diligently not to get involved in that. So a lot of them will do it because they've learned our products. They know that they've got an ear where Tracy can pick up the phone and call us, or we'll pick up the phone and call you and talk to you about a loan. One of the things that differentiates us a little bit, try to pick up the phone these days and actually talk to an underwriter.
Yeah.
And we've been doing that.
They shy away from loan officers talking to underwriters. I go through my processor, actually. I let her fight that battle. We've been doing that the
last 15 years. We want to develop more from the companies that we deal with, because again, we want the circle of companies that we deal with to stay very, very small.
Right.
So we just want to develop more with the companies that we've got these great relationships with. So I think I've answered that relative to risk, and then I'm sorry I keep doing it, but I keep coming back to common sense underwriting.
Yeah. Well, I liked it. Just would you lend this person money?
Exactly.
if you had the money, looking at the situation, looking at how they derive their income, and the asset and all the factors, would you lend them money? And that's the common sense comes in.
And that's the way it used to be. And I realize that I'm talking about a long bygone era, but that is the way it used to be. And all we've done with this is gravitate right back to common sense underwriting. And so happy to say our portfolio performs extremely well.
That was what I was going to conclude with, the performance, because obviously as the credit union, you have your members are putting the money in. The members must see that, why do we have all this bad debt out here? Why do we have all these foreclosures every month? And you mentioned you have
just about
barely
nothing,
a speck
really.
as far as foreclosures.
Just about nothing.
From that standpoint. So So listeners out there, there are other products, and portfolio lending fills a lot of needs. I know in our local area, sometimes the unwarrantable condos and so forth come up. Common that Fannie Mae and Freddie Mac don't want to get involved. I've had numerous times over the years. It's not every month, but where you just have that unique borrower, and you're like, unfortunately, just because whatever it is, they changed jobs or whatever it may be, that some reason they're not fitting it. But you're looking at them, going, man, I'd lend this person money. That's probably someone that we want to take to iTHINK and run through.
Well, and to wrap up, it can be that unique borrower. I think we've done a good job of covering that. It can be that unique borrower, but it can also be that unique property. You mentioned homes with a lot of acreage. It can be an equestrian property. What if it's somebody who wants to take title in a trust? And again, we specialize in that as well. It can be a foreign national. We're currently lending to folks coming out of about 42 different countries through our foreign national programs. It can be somebody who needs to cross-collateralize 2 properties. It can be a bridge loan. We'd be hours going through all this.
Yes.
But there's a tremendous number of ways that we can help in our various products.
I'm going to throw this one out here because this one came across, and it's been years ago. I think I was still with Quicken Loans a decade ago. Because of the growth of Florida, some of these homes that were originally just on just a common street as a residential property are now in a commercial zone.
Sure.
And the city says, if that house burns down, you can't build it back as a residential property. It can only be commercial. That
in and of itself is not something to kill a transaction over. If the property burns down, there's insurance.
Right.
And again, that's the hard part, is you put that fanny hat on and you say, okay, I can't do this because of this reason or that reason. We want to say, no, take that fanny hat off and let's look at this and see if it makes sense. One of the things that we've done, I know in St. Augustine not too long ago, we've got condos there that are actually you have a 2-story living quarters, and part of it is also 1,000-foot commercial space. That's fine. Yeah. We're probably going to have a lower loan to value than 80% on a primary for that. It's probably going to be more like 70. But that's a loan we want to look at because those can often make sense.
I had a situation. I remember this because I had to bring in my family. So I'm in Detroit with Quicken, and this was prior to 2008. So we had some of these we called them advantage loans. I don't know, they're some crazy stuff, but Fannie Mae and Freddie Mac would not allow. It was a property in Chickateague, Virginia. My grandmother just happened to have a mobile home there for many years, and family. So I knew where they were at. They had 2 manufactured homes on the property with a single-family home. Fannie Mae and Freddie Mac is not touching that.
Not going to touch it.
I literally had my parents, ironically, at the same time, were going to visit my grandmother there. They took the pictures for me so that I could show the underwriter that these manufactured homes still had their axles on them. The wheels were taken off, but they were just on cinder blocks. The axle was still there. So if someone really needed to move it, they could put the wheels back on and drag it off. That's what they wanted to know. And today, Fannie Mae and Freddie Mac would not get anywhere near that.
And what we want to look at, so let's take that scenario. So you've got a nice single-family home. Otherwise, everything's fine, and there's 2 what we would both call mobile homes sitting out back. If the wheels are on them, they're mobile. So we just want to make sure in something like that they're not causing any problems on the property, and that in fact we're not using any value from those inside the appraisal.
Right.
And other than that,
you're good.
It shouldn't be a big
these
deal.
are all things that could easily pop up in our local area.
Yes.
A single-family home with a manufactured home on it, that sort of thing. Well, I get the manufactured. You talk about large acreage. I'm sure you do have some manufactured homes on some extremely large acreage.
We do look at them on a case-by-case basis. Yes.
Yeah.
You've got to be very careful with that. There's a whole lot of rules surrounding that really aren't ours. I mean, here in Florida, you've got to comply with the state of Florida rules for anything that had originally been classified as a mobile home.
Right.
And so you've got to be careful. The story, and I apologize, I have way too
No,
many
go ahead.
stories. The story I always tell is we actually did an older manufactured home down in South Florida, I want to say it was about a $600,000 property, and it was because it was on a very, very small lot.
And the actual manufactured home might be worth $5,000-$10,000.
It wasn't worth very much. Now, that was the thing. The guy wanted to put down 30 or 35%. He was retiring there. And I think he did put down 35, but the house was on the water. So you have to, that's why it's really important to not say that there's any really hard and fast rules surrounding it. It's step back, be a human, pretend you're lending.
That might need another review, but it made sense. It's on the water. Where can you find waterfront property anymore?
And you know, we have, and obviously I'm biased, we have some of the strongest underwriters in the world. They've been in the Fannie world, they've been in this world, they like this world better. And I've never seen underwriters as good as these. These are tremendously good underwriters. But
that's someone who loves what they do, and the way they dig into some of these client stuff to make the loans work. They probably get excited. It probably makes their day.
Well, they're so smart and they're so strong at it that when they see something like that old manufactured home, and they say, but this guy is eminently qualified. You know what they do? Instead of punching numbers into a computer, they get up and go see the other underwriter and say, let's take a look at this. And let's make a decision as to whether this makes sense.
For your members.
If it does,
for your investors.
Let's service the member, let's take good care of them, and let's get on down the road.
Excellent. We've been going here. I'm going to just finish up with one last question. This is a question I ask every one of my guests, so it has nothing to do with iTHINK. But through your career, you've been involved in real estate in one level or another, whether it was selling it or obviously financing it today. Is it more important who you know or what you know?
Oh, from what perspective? From the perspective of a
just
banker
your career,
and
your career.
It's really what's important is what you know. It's not who you know. Our lending system proves that. You send us the file, we've never met the borrower, so it's not who you know. It is what you know and the sum total of your experiences and being a good underwriter, and hopefully I'm answering your question.
Well, no, that's your angle. That's your angle. My angle to your angle is I need to know you to get to the underwriters.
Well,
to me, it's who you know.
Now that's the second part of it, and that's why for people like you, you all have my cell phone number. You all know how to reach me instantly so that I can call you back, ideally very, very quickly with questions and try to answer questions or problems that you may have. That is based on the fact that we have such a small amount of brokers. We want that relationship with you because we've developed through you guys, through FBC, we have developed so much trust of what comes out of your firms over the years. That matters to us, but the trust came through the experience that we had with the quality of the files that you continue, thank you, to send us. So hopefully I've answered your question.
Very much so. I want to thank everyone for listening. Please like and share the podcast with your friends, your real estate friends, because I think not enough as I go and teach these classes of intro real estate, portfolio lending, that they don't even know what that even means. And to listen to our show today, hopefully get an idea, and then feel free to reach out to me for details, or you have that unique property, or yes, I have this client, but hey, my broker that I normally use says there's nothing he can do for him. They possibly may be an iTHINK product user.
Yeah, exactly. Run the scenario by you so that we can chat, we can take a look at it and see what.
Because we can run the scenario, and they say, based on it, as the product when I've gotten processed, they say, based on what you're telling me, this looks possible. Let's get all the documents and get me the facts.
That's exactly.
And then we move forward.
That's exactly right.
Yep.
That's exactly right.
Chris, I appreciate you being on.
I appreciate it more. I thank you for your time.
Thank you.
Thank you to all of you who are listening.
Yes.